At 9:30 a.m. on a perfectly ordinary weekday, the global financial system wakes up and assumes something dangerous. It assumes everyone will behave, that banks will lend, that markets will open, that buyers will show up, that trust, an invisible thing with no balance sheet, will still be there when the bell rings. Most days, that assumption holds. And because it holds, we call the system stable. But that stability is thinner than it looks. Here's the uncomfortable truth. Modern finance doesn't stand on concrete rules or iron laws. It stands on expectations, on habits, on people doing tomorrow what they did yesterday. When those assumptions break, even briefly, the system doesn't bend. It snaps. And that's why this matters right now. Because the world is more leveraged, faster, and more interconnected than at any point in history. Stability today requires more things to go right, more of the time, with less room for error. Let's start with something simple. Your money in the bank. Most people think banks store their money, like a vault. They don't. Banks lend most of it out. Always have. That's how banks make money. The system works because not everyone asks for their money back at once. That's not a guarantee. That's an assumption. If everyone did try to withdraw at the same time, the bank wouldn't have it. Not because of fraud, not because of mismanagement, because the system was never designed for that scenario. So why doesn't it happen every day? Because we assume it won't. Now scale that logic up. Banks assume other banks will lend to them overnight. Companies assume credit markets will be open when they need cash. Investors assume markets will stay liquid enough to exit positions. Governments assume bond buyers will keep showing up. None of this is enforced by physics. It's enforced by confidence. Confidence is efficient. It's also fragile. In calm times, these assumptions fade into the background. You don't notice them because nothing challenges them. But during stress, assumptions don't weaken gradually. They disappear all at once. That's when things get weird. In 2008, some of the largest financial institutions in the world didn't fail because their assets instantly became worthless. They failed because no one trusted the math anymore. Banks didn't know which other banks were exposed to bad loans. So they stopped lending to everyone. Overnight lending markets froze. Not because of new information, but because assumptions about safety vanished. The system didn't run out of money. It ran out of trust. And trust, once questioned, is brutally binary. Either it's there, or it's not. Here's where it gets more unsettling. After every crisis, we say we fix the system. We add rules, stress tests, capital buffers, safeguards, and those things matter. But they don't remove the core dependency on assumptions. They just shift them. Instead of assuming housing prices will never fall, we assume central banks will step in. Instead of assuming banks won't fail, we assume they'll be rescued. Instead of assuming markets are rational, we assume liquidity will always be provided. The assumption didn't go away. It changed clothes. Take government debt. Governments borrow by selling bonds. Buyers purchase those bonds because they assume the government will repay them. That assumption is reinforced by history, taxation power, and, critically, the idea that there will always be another buyer later. That last part matters more than most people realize. Many bond investors don't plan to hold bonds to maturity. They plan to sell them, which means the bond market depends on continuous demand, not just faith in repayment decades from now. If buyers hesitate, even temporarily, yields spike. Borrowing costs rise. Governments feel pressure immediately. That's not theoretical. We've seen it. When assumptions wobble, the reaction is fast and mechanical. Algorithms pull back, funds rebalance, risk models flip from safe to danger. And suddenly, stability becomes instability, not because reality changed, but because expectations did. Here's the irony. The more stable a system appears, the more it encourages behavior that depends on that stability continuing. Low volatility leads to more leverage. Reliable bailouts lead to more risk-taking. Predictable interventions lead to thinner margins of safety. This isn't stupidity. It's rational behavior inside an assumed framework. If you believe markets will always be liquid, you hold less cash. If you believe rates will stay low, you borrow more. If you believe someone will step in during crisis, you plan around that rescue. The system becomes efficient, but brittle. It's like a bridge designed under the assumption that traffic will flow smoothly. No sudden stops.
Our assumptions
no pilots,
were the real way.
no storms. Most days, It works beautifully, until one assumption fails. And when it fails, the bridge doesn't just crack. It collapses under loads it was never meant to bear. What makes this even harder to see is that fragility often looks like strength, right up until the moment it isn't. Rising asset prices feel like health. Tight spreads feel like safety. High participation feels like resilience. But those are symptoms of shared belief, not structural certainty. Financial stability is not the absence of risk. It's a temporary alignment of expectations. That alignment can persist for years, decades, even, which is why warnings sound abstract, alarmist, boring, until they're not. And here's a final twist. The people inside the system often understand this fragility. Central bankers talk about confidence channels. Regulators worry about contagion. Traders monitor liquidity conditions. Everyone knows the assumptions are there, but no one can remove them without breaking the system they support. You can't design a modern economy that doesn't rely on trust, rollover, and belief in continuity. The scale is too large. The speed is too fast. The complexity is too deep. So stability becomes a balancing act, not between safety and risk, but between belief and doubt, which raises an uncomfortable question. If financial stability depends on fragile assumptions, and those assumptions grow more stretched over time, and the system can't function without them, are we managing risk? Or are we just managing the timing of the next moment when belief finally runs out?